Let's start with a question most people never ask themselves. When you think about your car, do you see it as transportation? Or do you see it as a financial decision shaping your future? For most people, the answer feels obvious. A car is just a necessity. It's a tool, something you need to live your life. But that assumption is where the problem begins. In modern life, a car is no longer just transportation. It has become a long-term financial commitment. This commitment influences where you live. It influences how much stress you carry. It affects how flexible your career can be. It determines how much margin exists in your life. The most dangerous part is that this commitment feels normal. It even feels responsible. The car loan fallacy is a belief. It's the belief that because a car is necessary, payment structure doesn't matter. As long as the monthly payment fits, the decision feels safe. This thinking removes focus from total cost. It removes focus from opportunity cost. It removes focus from long-term consequences. Everything is reduced to one question. Can I afford the payment? That question has quietly redefined personal finance. A few decades ago, buying a car was simpler. Cars were less complex. Loans were shorter. Payments were temporary. You bought the car and paid it off. Ownership had a clear end. Today, car ownership looks like a subscription. Loans stretch longer. Vehicles depreciate faster. People roll one loan into the next. This cycle continues indefinitely. The system no longer encourages ownership. It encourages continuity. Financing a car for 6 to 8 years is a long commitment. You're tying future income to a depreciating asset. That commitment stacks on top of other obligations. Rent or mortgage already exists. Insurance already exists. Healthcare already exists. The car payment becomes part of your baseline. Once something becomes baseline, it stops being questioned. This is how a car reshapes your future. It doesn't do it through extravagance. It does it through normalization. You don't feel irresponsible. You feel average. Social validation reinforces the choice. Car marketing understands this perfectly. Ads never emphasize total cost. They emphasize monthly affordability. They sell identity and lifestyle. They sell safety and responsibility. The message feels reassuring. What's missing is what the payment replaces. Every dollar spent on a car removes flexibility elsewhere. That dollar can't build savings. It can't absorb emergencies. It can't reduce stress. The cost feels invisible because it's delayed. The benefit feels real because it's immediate. Cars feel productive. They feel necessary for earning income. That makes the expense feel justified. But cars don't generate income. They enable income at a cost. When that cost grows too large, it works against you. Modern cars are expensive beyond sticker price. Insurance costs have increased. Maintenance is more specialized. Repairs are more expensive. Technology adds convenience but increases fragility. Small issues can become large bills. Because the car is essential, delay isn't an option. You pay whatever is required. This creates quiet financial pressure. It doesn't feel like a crisis. It feels like limitation. Career choices are shaped by commute. Job changes feel risky. Income interruption becomes dangerous. Stress is tolerated because payments don't stop. Over time, the car becomes an anchor. Depreciation makes this worse. Value drops the moment you drive off the lot. The loan balance stays fixed. Many people owe more than the car is worth. This situation is common. Negative equity creates inertia. Selling feels impossible. Downgrading feels unrealistic. Staying feels easier than confronting loss. Upgrading deepens the fallacy. Negative equity gets rolled forward. The payment feels familiar. The obligation grows larger. This cycle can last decades. Meanwhile, life grows more expensive. Housing costs stretch. Healthcare becomes unpredictable. Emergencies happen. Without margin, these events destabilize life. The car loan didn't cause the problem. It removed the buffer. Car payments correlate with stress for this reason. They consume margin. Margin turns crises into inconveniences. Most people feel practical when taking these loans. They chose reliability. They chose safety. They avoided luxury. The deal still works against them. Financing prioritizes approval. Not well. Long terms reduce resistance. Reduced resistance allows higher prices. This design is intentional. The pattern begins early in life. Car loans come before financial literacy. Debt becomes normalized. Payments feel permanent. By peak earning years, no payment feels unrealistic. Owning a car outright feels extreme. The difference between payment and ownership is massive. It changes cash flow. It changes mindset. Without a payment, the car fades into the background. With a payment, it demands attention. Raises don't feel like progress. They feel like catching up. Extra income fills pressure gaps. Often, it upgrades the same The fallacy equates newer with safer, better with more secure. Real security comes from resilience. It comes from slack. It comes from the ability to say no. A car loan limits that ability. Life gets organized around protecting the payment. This shift happens quietly. One renewal at a time. One upgrade at a time. The alternative isn't deprivation, it's awareness. Transportation decisions compound over time. The real cost of a car is lost flexibility. Paid-off cars don't feel impressive, but they create space. Space to breathe. Space to plan. Space to absorb uncertainty. The fallacy survives because it hides behind necessity. Separating identity from transportation clarifies the math. Clear math reveals honest trade-offs. Your car shapes how easily you can change direction. Flexibility may be your most valuable asset.